to attend. And there will also be opportunities to watch those over the coming days. So our final panel is our much anticipated and always appreciated CFO panel, providing the insights into what traders are dealing with in terms of commodity prices, strategy, uncertainty, the changing economic landscape, and everything that we have been seeing here over the last couple of days and hearing about. And joining our panel, I'll ask them to come up while I'm just introducing them. We have Jeff Della Pina from Vitol, Richard Dolcetti from CCI, Stefan Jansma from Trafigura, making his first appearance on this panel, Guillaume Vermersch from Mercuria, and Jeff Webster from the Gunvor Group. The session is going to be moderated by Leslie Hook, our Natural Resources editor, and she will then close the summit. So I just want to use this opportunity while the panel is settling in to thank you, our audience, for your active participation here the last few days. And also just let me take an opportunity to thank my FT and FT Live colleagues behind the scenes, the AV team, and the hotel and security staff for the smooth running of the summit. I look forward to seeing you all again here next year. So, Leslie, take us home.
Thank you, Andrew, and thanks to all of you for closing out a fantastic 3-day event. We're saving the best for last here. And my opening question is that I'd like to ask you to set the scene a bit. We've had, the last couple years, we've had a lot of record profits. It's been some very, very good years for the industry. Now we're on slightly leaner times. I think that overall commodity trading firms saw about a 25% decline in margin from 2023 to 2024. So things have come down a little bit. But tell me a bit about your financial performance last year and how things are going this year. Jeff?
Yeah, thanks, Leslie. Naturally, we're coming off of a pretty unusual couple of years. You know, the confluence of events that led to the profits of 21, 22, and 23 were very unusual. We wouldn't expect them to repeat themselves well. And, I think what happened was we've all built systems that can scale and that can opportunistically, enjoy expanding margins when circumstances are appropriate. But naturally, in this business, in any business, margins compress, they get attacked, and eventually the market, becomes more efficient. Governments respond to dislocations, and profits start to decline off of an unusual high. And I think we're all experiencing, we certainly are experiencing that.
And at Vitol, how have the profits from those boom years, if we can call them that, reshaped the business? And how much of that have you reinvested in maybe in assets versus repaying as dividends?
Combination of the two. We're definitely investing more, but stubbornly, it's still difficult to put a substantial amount of our capital into absolutely new businesses, whether it's industrial or new trading businesses. It's the natural posture and cadence of the firm is to take things very carefully, very slowly. And we've been fortunate enough in the last couple of years to close on a couple of acquisitions, one in South Africa, one big one in Italy, and there's a number of other emerging businesses we've put money into, not of that size. So we'll continue to do that, but irrespective of the intention to continue to expand the nature of the business and the breadth of the business, it's still complicated to get those deals done. So it doesn't materially change the balance sheet. So it'll be gradual, as it always has been.
So kind of a gradual reinvestment of
Yep.
those profits. And Rick, I want to come to you next. How's this period been financially for CCI, and what does this year feel like in terms of financial performance?
So obviously you're going to get the same theme probably from all of us, right? I mean, we just came off a number of years that had tremendous opportunities in the marketplace, and when those opportunities aren't as prevalent, you're not going to be able to solve the problems of the supply-demand imbalances, and you're going to make less money doing it. It's just part of the business. So, like Vitol and like I'm sure all my colleagues, the profits aren't as robust as they were, You probably remember a couple years ago I had mentioned that we got a really nice letter from Geneva thanking us for all the revenues. Probably not going to get another letter this year, is my guess, once I file. But I'll still look back on that fondly. But you know, it's you do what you can with the opportunities that are there, and you're tracking it constantly. You're doing your risk management, which is very robust where we are, and you continue to look for opportunities and think about how to grow, right? How to think about different areas, how to expand where you can actually get more opportunities than you had the prior year.
Yeah. Yeah, and Jeff, tell me about Gunvor. How's your financial performance been?
Yeah. Well, first I noted Jeff also managed to avoid answering that part of the question, but he did set the scene very nicely.
You want to elaborate, Jeff? Do you want to share your results with us right now?
He does this all the time. I'm used to it.
But yeah, we had a solid performance. We do have reporting obligations to our banks and bondholders, so I know you put us on last on this session, but still I need another few days before we can get the numbers out to you. But it will be comparable to 2021, so obviously that peak and bumpy years, I think as you described them, of 2022 and 23, obviously now, you know, enshrined, but we're not repeating those kind of results. Of course, the big difference, and I think it's important to remember, even if the markets have somewhat renormalized, you know, the effect of such a significant period of volatility and profitability has changes the market. So two things: we're all sitting on significantly more capital than we had before. I mean, when I joined, so we're now about $6.5 billion of equity. When I came into this industry 2018, I think it's roughly what Trafigura had. So we're kind of at the same sort of level. And I thought, how do we ever get to that kind of level? But you're now 2-3 times above that level.
Not anytime soon.
Not anytime soon. No, not anytime soon. Though our RCF spreads are still well above what yours were at that level. Find that out.
But just picking up on that theme of you know, you are sitting on these profits, and how is that going to change the shape of Gunvor, and how much of that are you going to reinvest?
Key point. So how do we invest those? And the other point is, of course, you know, a period of high profitability attracts competition. So actually we've seen increased competition, a lot more entrants into the market, majors who have added trading arms, you know, hedge funds, CTAs, etc. And in some ways we're going the other way, and we're starting to add physical assets to build a trading platform, because if you can't compete in a spot market when it's so competitive, you need structural positions, you need long-term relationships, you need assets that produce steady flows and some form of steady income. So we're looking very much at investing in such assets that will complement our trading business.
Physical assets on the both oil and
oil,
metals.
gas, renewables, across the entire spectrum of what we trade, and metals as well. I'm sure we'll get to that later in the session.
Yeah. And on financial performance, do you think the profits of these bumper years will be repeated, or was this like a once-in-a-lifetime?
I stand there and say I would love it to be the case. I mean, obviously, you've got to remember the environment that created these bumper profits. I wouldn't like to another war event like that to be repeated. So I don't expect it, but we do know the industry is cyclical. And this period of relatively low profitability may not be repeated either. We may have, you know, cyclical ups and downs, but maybe never to the extent in our careers of what we saw then.
And Stefan, can you tell us a bit about Trafigura's financial performance and how this year is going so far?
Sure. I think our financial performance has reached a new cruising altitude, and that cruising altitude is significantly less than the 2 years which were a very high profitability, but also it's significantly higher than the profitability we had before the COVID period, so say. And why do we have higher profitability on that sense? I think it's got to do with the fact that we're way more diversified than we previously were. We currently have 25 trading books, and if every book makes a decent profit, we actually have a very good semester. And that profitability also comes from the fact that, you know, our services are in higher demand these days. You know, security of supply is still something that our customers find important, both on the buying and selling side. And the role that we play as a shock absorber in the industry allows us to benefit from those shocks. In terms of CapEx, I think it's interesting to see that last year we had 3 large capital expenditures. One was a refinery in France. Second, we bought some power plants in the US. And thirdly, we bought a fuel distribution company in the UK, a roadside fuel distribution company. So what you see there is that we invest actually in OECD markets, because at the moment we believe that OECD markets give us the best risk return for the investment that we make. And that also means that our balance sheet, which is continuing to be stronger than it was pre-COVID, is also massively changing, not only in terms of strength, but also of composition. If I look at our receivables, these days our largest receivables are supermarket companies in France and in the UK. At the same time, also on our liability side, our largest provider of finance last year was the German government by means of COFAS, and also the US government in terms of US Exim is a large provider of funding to us. So not only is the balance sheet becoming stronger, but also the individual components changing that significantly versus a few years ago.
Mm-hmm, mm-hmm. And you say you've reached cruising altitude in terms of level of profitability. Do you think the profits, the record highs of 2022 will be repeated?
I think the way we set up the company from a trading perspective in terms of the trading books that we have, the focus on operational performance that we have, I think we're very well suited to capture anything which comes our way.
Yeah. And how do you balance between reinvesting in assets, which you've mentioned some of the big asset investments that you've made, and also paying out your shareholders?
I think if you look at the last 4 years, we've made over $20 billion. Roughly half of that we kept in the company to strengthen the balance sheet, which means that the rest is available either for CapEx or for ensuring shareholder return.
Yep. And Guillaume, tell us a bit about Mercuria's financial performance over the past period. I think there's some numbers that are already public in the headlines, if you can share those, and how are things feeling this year for you?
So first, thank you for that. I agree with Stefan, it's important to look at the receivables. But putting that on the side, I think it's a little bit of all of the above. I think what is important from this extreme period and a very high, I would say, return realized across the industry is what we now became. And how stronger I think we all are with differences in our respective strategies. Investments have been very important. You heard that from Marco Duno, our CEO, yesterday. I think we all have invested, but Mercuria has invested in particular in the natural-based space, which is a very important class of assets for us, as well as in more conventional and traditional energies. We probably are following a different model from a balance sheet perspective, thinking of adding value and unlocking value around assets without specifically being the owner of that assets. So we like, to a certain extent, and when it's possible and when it does make sense, to be a minority, actually, shareholders, a minority participant, or simply contribute to unlocking that value through credit and debt instrument. So there's maybe nuances and variation around our different models, but it's all about, being now sitting on a stronger balance sheet, stronger equity, learning a lot from that high volatility period. We haven't talked about risk management and I guess across our organizations, the push or the wake-up call in some instances that we receive to actually enhance and improve those processes, and that's, I think, very important. And it comes to liquidity risk, contingent liquidity, organizing the balance sheet. So it has effectively transformed our organization, and I'm sure it's probably true for everyone else. When it comes to financial performance, yes, I have been told that they are now public, so I'm inviting everyone to surf on the
I think
web.
It was a net profit of 2.1 billion in the year ending.
That's what I have been told,
September.
yeah. So that was the number at the end of September 24, yeah, our closing date.
Yeah. And do you think that the record profits of the previous period will ever be repeated?
It's hard to say. Obviously, nobody wants to see, the the events that triggered, that extreme volatility and ultimately our capacity to navigate those markets and actually bring solution to distressed market. I think that's very important. You never know. I think we heard over the past 48 hours a lot of concern, a lot of uncertainty around geopolitical situation. That will certainly bring another wave of volatility across commodities, and that's probably good to be stronger and probably more sophisticated in everything we do from a risk management perspective to navigate those new markets.
Yeah. Well, my next question is on risk management and fraud risks in particular. So you've set that up very well. Jeff, I'm going to start with you since you're sitting next to me. How has your assessment of risk changed or evolved in the past year? Are there new risks that are sort of keeping you up at night, and fraud risk in particular? We've seen some big examples across the industry. How do you deal with that?
I don't think it's materially changed for us. I think as the business expands naturally, it's just harder to control with a small group of people supervising that. So we have more on the ground sort of distribution business activity, and I think that just requires really important investment in systems and culture and all of that. We have a natural defense mechanism with our shareholder structure, which I think a lot of us do that as well, where we distribute a lot of the wealth and partnership of the firm across the board. So irrespective of where you sit, you can be a partner, and naturally the defense of your position as a partner is tremendous in terms of discouraging anybody from bad behavior. There's always going to be fraud risk on the outside, and you have to be a little bit careful about that. But I think it's generally okay. I don't think it's changed that much for us.
And Rick?
Yeah, I think we have a little bit of an advantage in that, Bill, I think, purposefully keeps us in markets where that risk is much less, right? We focus on North America, continental Europe. We used to send cargoes down into Latin America. We don't even do that anymore, quite honestly. So it's probably on a risk scale a much lower risk for us than it is for some of the markets that my colleagues here deal in. But I think to Jeff's point, and Richard said this yesterday, culture is so important, and making sure that the day-to-day folks on the front lines understand that they need to think about what they're doing. They don't just do things. They need to think about it, understand the business. You need to train them, and you need to make sure that there's a transparency in the culture. It's really important that if you train them to identify potential problems, just things that look odd, that they'll actually speak up and say something, and that they have the confidence to do that. And so that type of culture and breeding that culture is incredibly important. And that's one of Bill's high priorities in the firm.
Mm-hmm. And Jeff?
Yeah, I fully agree with that. So rather than repeating the generalities, maybe I'll give you a specific example. We're almost subject of a fraud yesterday. So my US CFO received a text message claiming to be from me. Hi, Thomas, it's Jeff. We need your help with a confidential acquisition. Please, contact me on my private number. Yeah. And to his credit, he spotted it within 2 words, because I only ever call him Tom. But it's just an example thing. But actually, I'm flattered I got impersonated. Right?
Exactly, needs help.
Frankly. But
This is going to be like a therapy session.
Exactly,
Yeah,
yeah.
exactly.
Exactly the kind of, yeah. Maybe they got the wrong Jeff. That would be very confidential.
Yeah.
But
I don't.
this just shows you, we do train them. We tell our guys, if anybody says we need to use a different bank account this time, alarm bells should be going off in your head. You need to be on the phone to somebody, or have somebody do a backup call to make sure that's really what is meant. Anytime you hear something that just doesn't fit what you're used to, assume the worst until proven. It has to be literally guilty until proven innocent in such cases. And then in terms of, we're constantly improving our compliance function. It's grown substantially in the last few years to try and prevent all of those kind of events. I think it was your CEO actually yesterday who correctly said that no matter what systems you put in place, you can never completely rule out. In fact, the biggest risk to facing a fraud is to think that you've prevented any possible chance of fraud. You've always got to be suspect to it and prepared for it, and just keep improving your systems, using technology, using culture, using education to do so.
And technology and artificial intelligence also give fraudsters new tools. Like, I mean, writing a text message is one thing, but impersonating your voice or even a video of you speaking now here. I mean, we're all being recorded, right?
Let's see what comes out.
I've got a confidential acquisition for you. Stefan, on to you next. How has your risk assessment practice evolved? I mean, Trafigura has had some pretty big fraud losses in the past year.
Sure. I think it continues to evolve, and your focus changes from time to time. I think if you would ask me for the last 10 years, I think our focus was predominantly on liquidity risk. I think the profits that we've generated over the years has meant that liquidity risk is definitely a way less concern, but also because a lot of the liquidity risk management products we put in place, right? We're a self-clearer on ICE, for example. We do a lot of EFSs, exchange for swaps, which reduces the IM, the initial margin, and the variation margin risk. So liquidity is far less a concern. But obviously, as you would probably expect me to say, right, fraud risk is definitely high on the calendar. And there we're taking a lot of different actions, right? So you heard us talking about Speak Up campaign that you quoted. We've done a lot in our compliance framework. We started a project on governance and risk management, whereby we are making small amendments into our operational performance, just to be a little bit smarter and a little bit sharper. And we invested heavily in our compliance framework, but also in internal audit, internal control, our teams, which we've beefed up a lot. We set up a risk technology team, which uses big data to try to analyze anomalies in the trade flows that we have. And for that, we've hired quite a few people from banks, from big four companies, from hedge funds as well, because I think banks and hedge funds, right, they've been through the financial crisis, they've been through a lot of fraud cases, and we can learn a lot from them, right? So in that sense, we've hired new talent as well to ensure that we're better equipped for anything that comes our way.
Mm-hmm. And I have to ask a follow-up question here. I don't mean to pick on you, but in the past year, you know, Trafigura reported a 1.1 billion loss due to the Mongolian oil fraud. What are the lessons learned from that situation for you?
Well, the lessons learned are a couple, right? I mean, first of all, it was a unique situation. It was operated in a remote country. We have 12 people in that country who speak one language, which doesn't exist in any other part of the company, which create a barrier for you to be more in control of it. We learned the lessons from being more in control of the operational risk. But I think we've tackled most of those things. We're on a process. And I think the banks have really helped us in that, right? We went out to the banks before the news came out so that they are aware of what's coming. And we've had very frank, but also constructive discussions with them because they have a lot of experience and we can learn a lot from them, which meant that we had like I said, constructive discussion, which just meant that we still have all the support from them, right? I think we have a lot of banks who provide us more than $1 billion in facilities, which means that you don't have a borrower-lender relationship, but it's really a partnership. And in a partnership, you try to help each other and learn from each other. And hence, you've seen recently we announced the closing of our European RCF, which is the cornerstone of our facilities at a record level, right? So that's the proof that the banking market believes not only in our balance sheet, but also in the operational changes that we're making, as well as in the new management that we put in place.
And Guillaume, maybe you can speak a bit about risks and how your risk management practices have evolved.
Sure. I mean, as far as fraud and fraud risks are concerned, I was listening, you know, and agree with everything that has been said. I think technology is probably the big driver. I mean, from I would say management and you know, strategy almost, you need to be control freak, right? You need to, and we heard that at different occasions, you need to understand all your data, you need to understand and get access to those data, you need to analyze them at every point of the supply chain, of the value chain, of any transaction, shall they be financial, physical, etc. But technology is a big support within Mercurian. And typically beyond the big data sorts of analysis and stress test scenarios that we're running or identifying patterns. And obviously, I'm not talking about the whole cyber security aspect, which comes with a lot of technological features. We're using in the physical, more and more in the physical flows, technology in the form of satellite images to detect, movement of stockpile, number of entries in certain areas and stuff like that, which is another way of informing your risk in a way and be able to, react probably proactively more than after the problem. Now, can you, and I think we probably all agree, can you say that we all immune against, the next sophisticated fraud? No. You need to revisit, your process. You need to adjust your technology. You need to push your compliance further. You need to push your data further, and that's a continuous process. I mean, that never stops.
Mm-hmm. And you guys are kind of in some new playgrounds with metals, for example, and mining, where you're maybe providing financing to different types of projects. Does that bring new risk concerns?
Well, it's a new area, new sector, obviously, to Mercuria to a certain extent. We were already big in the aluminium space, but obviously we're opening up the book today. So it's new countries, new counterparties. We apply the same, I would say, strict and very tight control over those new stakeholders in a way. As we mentioned at different occasions, we are de-risking a lot the position that we are running, so which is an important development in our financing and liquidity equation, in the sense that we're teaming up with a lot of credit funds, as example, that has the expertise, knows the assets, knows the counterparties, and are part of from a credit perspective, as example, a de-risking solution. But it's all about going stage by stage and applying the same rigorous, process on everything that is making the strength of our risk management system: KYC, credit, market risk, hedging, mitigant, insurance. I mean, all the tools are used to reduce those risks.
Yeah. My next question is going to be on tax, and I'm going to switch the order. So we're starting with you, Guillaume.
I'm the new Jeff.
Yes. The OECD has introduced a global minimum tax that went into effect last year. What impact has that had on you, and what is your effective tax rate?
I think, our position is relatively simple. I mean, there are obviously sector items and when it comes to law and regulation that you can't trade. You can't really optimize, you can't really, you have to follow the rules and the law. So when a number of countries are aligning through Pillar 2 that you're referring to, their tax rate base, you have to integrate that in your funding cost equation, and that's a rules that you can't really, bypass, because we don't bypass any rules, obviously. So you have to integrate that new data and deal with it. So it's very much dependent on, what kind of trades you're doing, in what kind of jurisdiction. So there is an optimization, obviously, of your equation. But at the end of the day, when the rate is the same everywhere, you'll have to pay the rate.
And is that what is your effective tax rate?
Well, that would be the rate that we're talking about is 15%. So there will be an alignment around this 15%.
And Stefan?
Yeah, I mean, I think we're a Singapore headquartered company, but we have 55 offices around the world. So obviously we pay tax where we are booking trading profitability. So in that sense, it depends where we make the trading profitability, exactly how much tax that we pay. Pillar 2 is indeed, like Guillaume said, it's a fact of life, and it's something you just absorb in your business, right? In terms of effective tax rate, we publicize our financials, so you can clearly see what it is in there.
But can you remind me what it was?
I haven't published my financials yet, right? So it's June this year that we publicized the 6 months only.
And Jeff, I know this is your favorite question. So.
Yeah, well, a strategic placement deal here, so Guillaume got that one question first this time. To be honest, it's because we don't spend a lot of time thinking about it. As Guillaume rightly said, we have to follow the laws in the countries we are, and as members of the OECD, the universal tax rate. But where we make most of our profitability, in Geneva, our tax rate is pretty close to 15% as well. Our parent companies in Cyprus also fairly close to 15%. But even with this universal minimum tax rate, you still got other features. You still have deferred tax assets which you can use to offset tax in profitable years. Shipping is still out of that process. So to the extent you're making P&L in shipping, and shipping is a big part of a lot of our trade flow, that doesn't feature under the minimum tax rate, and there's other things in other regimes as well. So it hasn't changed too much for us.
All right, and Rick, you guys are a U.S. domiciled company, so you're a slightly different ballpark.
We are U.S., so Jeff likes to tell me, man, this is such an easy question for you.
Yes, it is.
U.S., it's just so easy. Now, tax is never easy, right? I'm a tax lawyer, and I can tell you right now it's never easy. And as Guillaume said, even if you have a minimum tax rate, there are still areas of the world where you can try to optimize, because there are places where the tax rate's higher than that, right? Including the U.S. There are lots of places where it's higher than that. The UK is higher than that. And I think what we're finding is that what the jurisdictions really want to know is not necessarily that you're just paying the 15%. It's where are you paying that 15%, and should it be higher than 15%? And should we be transfer pricing more revenue to those areas that are higher than 15%? And that's, I think, where this is going. I think I mentioned this maybe a couple years ago as well. And so I think thinking that everyone's just going to get away with something lower than a 21% U.S. rate or a 19 going higher UK rate, always going higher UK rate, exactly. As these governments run low on revenues, they're going to look to people who are profitable, including industries like ours and asset management industries. And they're going to ask how we're transfer pricing our revenues, where we're earning our revenues, where the people are, where the capital is. And it's always going to be complicated. I do think a lot about it. And there are ways to optimize it. I mean, look, part of our structure is a U.S. corporation, and part of our structure is a U.S. partnership. Those are very different tax jurisdictions, ways to think about taxes, I should say, and different tax regimes. And there are benefits of having some assets in the partnership versus some assets in the corporation. So there's always things to do here, but I do think there's a lot more coming on this.
And Rick, I want to take a little side step here with you, and also ask about tariffs, because you guys have been right in the middle, front row seat on the tariffs changes, particularly when it comes to importing Canadian energy into the U.S. There's 3 days when tariffs were on, and then now they're off. They could be back on at any moment. How do you deal with that?
Yeah, I think Bill addressed this a little bit yesterday, but it's complicated, right? And the most complicated thing about it is not just understanding the gas flows, for example, how they're coming in, where they're coming in, whether they're coming in, going back out, then coming back in, and understanding what are the relative prices that you should be basing the tariffs on. It's complicated just to get that information, to understand that information inside your organization, but also to understand what your contracts say, who's supposed to bear the risk of that tariff, and then understanding how the governments are going to enforce it. So you put all that together, and you pretty much have a daily workforce that is working group that is made up of our risk managers, our lawyers, our tax people, myself. Our compliance people that are looking at this constantly. And it almost doesn't matter that they sort of come and go and get pushed off. You always just want to know if they're going to be in place, what is going to be that implication. But we treat it like any other risk management area, right? This is a potential risk for the business. We need to understand through data what it means, try to quantify it, try to quantify the probabilities of it, and then and deal with it that way.
Thanks, Rick. Now, going back to the tax, Jeff, what's your sort of effective global tax?
Effective global tax. Well, we're all paying the 15% OECD, requirement. When you look at financial statements, ultimately, you can't really sort of discern that number very easily, because there are lots of things that are unimpacted by this, whether it's shipping transactions, capital transactions, so and associate behavior. So if we have unconsolidated affiliates, you can't really see that flowing through the tax line. They're paying it themselves. So there's no question, these rules have created more administrative burden. It started with CBCR many years ago, and it's just adding on more, more analysis, more burden. We're a European company, so we're going to be living with this, for a very long time. We don't run the company based on tax optimization. It's run on what's the best place to be domiciled to attract the right people. And, for now, the location preferences still of our shareholders still tend to be in pretty high tax jurisdictions. So, but obviously we have some stuff historically in the Middle East and in Asia, which were better, but obviously they're being influenced by these rules. I don't think it's going to have any immediate impact on any of us, but it is more of a burden. And, frankly, we all spend a lot more time on it, unfortunately. Mm-hmm, mm-hmm. And I'm not trained like him, so,
And that is alone a burden, right, Jeff? Just to have so many resources thinking about this constantly, and then to the extent that you do have engagement with governments, they want more and more and more information, the same information. They don't understand the information. So, it does put a bit of a burden on the organization that you just have to deal with.
Yeah. Now, I want to give you, the audience, a chance to ask questions. And if you're watching this online, you can also type your questions into the box, and they will show up on my iPad here. I also have a few more questions that I would like to ask, but I'll just give the audience a chance to jump in here. We have a question in the front row. Please just state your name and ask a question.
Thank you. My name is Harris Antonio from Neptune Maritime Leasing. A question relating to the geopolitical rivalry that we see. Does it affect in any way your funding plans? Are you planning to kind of change the composition of your lines or bank relations?
Thank you. So a question about geopolitics influencing funding. And we also have two questions from online, which I'm going to throw into the mix here. The first is there scope for consolidation in the commodity trading fraternity? That's their word, not mine. Do you see large traders playing a bigger role in providing pre-financing facilities for mining projects? So we've got three questions there. And perhaps we can start, we'll get to all three, but perhaps we can start with the question on, is there room for consolidation? Who'd like to take that one?
Jeff.
I'm not sure.
My
audience to answer that one.
Exactly.
I can't imagine anyone on this stage here is thinking about that at the moment. Consolidation generally comes in the form of people movement and potentially asset acquisition. I think all the firms are generally robust enough financially, and consolidation is about being more competitive, potentially having more firepower, and generally I think everybody's been able to do the business they want to do.
There's maybe consolidation around, if I may, Jeff, around certain verticals. Yeah. If I'm thinking of the business model that you guys are following, we're talking about upstream, refinery, downstream as example. Yeah. That's where you see some sort of consolidation along verticals. But between the various business models that we are representing here, it'd be very hard, I think.
Yeah, we need to drop the fraternity thing. That's that can go in the wrong direction. So let's.
All right, fair enough.
I think what you see is that the cost of doing business has gone up over the past few years, right? On one side, it's simply because of inflation, but on the other side, also our business models have become more complex, right? If you look at us starting to trade power, for example, to finance and control and risk manage power, you need different skills than when you do crude oil. Right? If you have a refinery and you start selling into multiple currencies, you need a different funding model, you need more skills, you need more risk management. So at the same time also from a compliance perspective, right? You need more risk management to adhere to regulatory compliance, to exchange compliance. So cost of doing business has gone up, which also means that the barriers to entry has gone up, right? So I can see consolidation happening more from smaller trading companies who get absorbed maybe into the bigger companies. Rather than consolidation amongst the American table or the European table.
Yeah, the industry is always evolving. You do see some of the majors, for example, selling assets. They're trying to return money to shareholders. Private equity firms trying to return money to investors selling assets. and a lot of capital to deploy on the trading houses, using to invest that. So you see some blurring the lines now between the verticals, between majors entering trading and trading companies looking to add more infrastructure assets. But as I said, I think on the consolidation question, it's more a question for some of the smaller, medium-sized traders.
Mm-hmm. And we also had a question about, do you see large traders playing a bigger role in providing pre-financing facilities for mining projects? I think we've seen some Nigeria do some very recent deals like that.
Just, absolutely. I think we, and that's probably true for all of us, when we look at penetrating, helping, adding value to a given sector, so that works for mining sector, but it works equally to other classes of assets. You deployed all the tool, all your expertise that you think are relevant to the sector. So and some of those tools is the capacity to fund, to de-risk, to prepay, to organize pre-export financing or whatever, with the help obviously of your liquidity provider and banking partners. So of course, it's part of the value added that you bringing to the sector.
In some ways, it's part of the energy transition. So you've had energy sector companies generating good revenues, looking to expand, build their business, entering into the metal sector and actually then investing some of those capital into metal businesses, potentially through prepayments in order to expand those markets.
You guys would look at as well.
Yeah. That would be part of our strategy as well. We've all taken slightly different strategies. You've obviously been well established in metals, but there are many different ways to enter that market, and that's one of the ways we're looking at.
Yeah. And we also had a question about how geopolitics is changing sources of finance. And I guess I would add to that question, what are kind of the new sources of finance that are available, that are interesting to you guys?
Yeah. I think for us, right, we've always been trying to be as diversified as possible globally from banks in different countries around the world, but also from different liquidity providers. And in that sense, I've seen the entry of export credit agencies into our market, whereby governments have mandated export credit agencies to ensure that strategic commodities like gas or battery materials come into their country. And those ECAs, those export credit agencies, have found us as a reliable provider in that. And hence, we've done $6 billion of ECA finance facilities over the past few years. And that's been a really new source of funding for us to facilitate longer-term trades into those countries, right? So I would say that's a new and innovative source of funding.
Do you see that maybe on the energy side that's going to dissipate? There's maybe not the same political willingness to finance sort of gas imports, but on the critical metals it actually may increase. So actually that could be
applying for a new role as a...
No, not applying. Just saying, pointing out. So we've done one on the energy space, but in 5 years' time or 4 years' time when it comes to mature, will the demand of European governments to back a gas import facility be the same? I think the geopolitical situation could be very different by then. We may not be in a position to renew that simply because the demand isn't there.
And we've tried to develop a lot of these ECAs as relationships, right? So not only to have one trade with them, but they also support us in maybe some prepayments in their zip codes, or some participation in other facilities. So a lot of them have really become relationships to us, just like the banks. So I'm confident that it will be a more longer-term, sustainable source of liquidity for us.
Yeah. Mm-hmm. Jeff, anything to add on that?
No, I don't think geopolitics is going to be the big driver. I mean, ESG, obviously, views on climate change, the impacts, in the central banks or the ECB influencing the way banks support businesses was the big changer. I don't think any geopolitics, that we're facing today is going to add or detract from any of the support we get.
From your financiers.
Yeah.
I'd like to ask, and we only have a few minutes left, but a little bit about what's ahead and your feeling for what this year is going to be like, how it's going so far. Jeff, okay. You're sitting next to me, so I'm starting.
Yeah, all right. It's going fine. I mean, we've all big physical flows. We have big asset positions, so the general operation of the business and the extraction of premiums, discounts on commodity flows, is still continuing at pace. I think the big feature at the moment, and it's tariff related, it's conversation related, is the effectively the removal or the reduction of risk capital in the market. We're all becoming intensely, certainly we are, intensely research-based organizations that spend a lot of time thinking about balances, a lot of time tracking commodity movements, and we'll take views on that are well researched and that are medium-term views. And I think today, because of the impact of statements when we wake up in the morning, those statements can overwhelm any of the research we do. So it just naturally, it's not a strategic initiative to reduce risk, but it naturally draws away risk capital from the market, which then serves to compress volatility, which then obviously has put us in much tighter trading ranges on core commodities.
And you're referring to sort of the Trump tweets and the volatility and uncertainty around.
Yeah, all of that, exactly. Trump responses on tariffs, whether or not it ever really materializes to the confusion that could arise that Rick was describing in terms of trying to actually model what all of this means. We're all sitting there trying to figure out, will it ever really happen? But if it does, it's going to get complicated, and it's very difficult to put a risk view into the market right now.
And confusion has its cost.
Yes, but we're not going to cry here. The cost is the temporary reduction of opportunity to make margin, right? The cost isn't going to bleed us to death, but yes, it's something we just have to live with.
Yeah, I think Jeff hit the nail on the head, right? I mean, this is all about what our analysts are doing as far as where our research is. We all have very deep research. And the volatility of the news and the geopolitical things that are going on and the constant change always makes you reassess. Now, you're always doing that. It's just you're doing that in a much more volatile way every single day. And you need to figure out how that impacts the markets. But I think most importantly, still there should be long-term visions, right? You need some growth strategy. We all have incremental capital that we still haven't invested, I think, from the past few years. And the real question becomes the strategies that we've developed to grow using that capital, will those continue to be profitable strategies, or do we need to pivot? But you can't do that on a daily basis. You still need to have a vision and think long term. Trump's not going to be president forever.
He might be.
You need to deal with
There might never be another election.
Pretty confident as a U.S. citizen he won't be. But like Jeff said, you just have to deal with it.
Yeah. So you think this, in terms of financial performance this year, do you think it will be similar to last year for you guys?
No, we're always looking to make more money.
So Jeff, over to you.
I'm actually grimacing because I just lost my bet that we're going to get through this without Trump's name being mentioned. But I think that tells you something about the world we're in, that you can't get through any panel without the president being mentioned, because he is, obviously what happens to his administration and how some of his policies, how they change, how they actually land, and what that means for the global economy, etc., will have unpredictable effects. So it's very difficult for us to sit here and say what the year's going to be like. We're only 3 months in now. I can say, as I agree with Jeff, this kind of volatility we're seeing, which is tweet-driven or it's missile-driven based on who's breaking what ceasefire, who's not, who's entering a ceasefire, is very difficult for us to trade around. So actually we're fairly risk-off right now for that reason. Prices are extremely range-bound. And when you talk about normalized markets, we've actually looked at the range that crude has been in for, over 12 months now. It's actually a normally tight range, and there's a lot of stabilizers on either side of that. But with the situation it is today, we know it could change very rapidly, very quickly, in a very different way. So we're really about positioning ourselves to make sure we can take advantage of that as and when it changes. In the meantime, it's fighting hard. I mean, our traders are having to work twice as hard to generate maybe half the profit they were before, simply because of the conditions. But that, they've been through that before.
And Stefan, how's this year? Your financial year ends in September, so you're already sort of halfway through. How's it going so far?
Yeah, it's going okay. I think if I think back 2 months ago, we left the World Economic Forum in Davos, and our conclusion was, right, the US is doing fantastically well, Europe's got a massive problem, and China has a problem. We're only 2 months ahead, and that view has completely changed, right? I think there's definitely some headwind in the US. I think Europe is doing a lot better than we all expected, and last week we had some of my colleagues in China coming back with a way more optimistic view than they've had before, right? So conclusion is that the world is very volatile and will probably remain so. And I think a volatile world, it requires a company who's agile, who's able to change quickly. And I think that's what we're fully set up to benefit from. So on the trading side, I'm quite optimistic to have a similar kind of result that we've had over the past semesters. I think our other focus currently is on accumulating and incorporating the assets that we've acquired over the past few years and ensuring that we have the right governance and human capital around that to really benefit from them.
One of the themes here, though, is just this uncertainty and this uncertain policy environment that you have to operate in. And how do you deal with that?
I think the biggest challenge there is more for the producers, right? I think volatility is something which is beneficial for a trader. But if you're going to make an investment for the next 5-10 years, you want to have certainty on policies and procedures that are applicable to them, right? So I see the, may I say, flip-flopping regulations more as a challenge for long-term investment into sustainability, into upstream assets, into mining assets, because that's a difficult choice to make. I think for trading companies, it's a challenge on our asset side, but on the trading side, it's more an opportunity to benefit from that volatility and provide the service to our customers that they want.
Yep. And Guillaume, you have the final word here.
A word of conclusion, looking at the watch.
How's this year going from a curious?
Yeah, I think it's obviously, as we all said, it's a different landscape, different market. I see very much so the added value that we're bringing through our diversification. The margin has migrated because we are in a world more sophisticated, more complex in a way, and that is changing. So to a degree, volatility is the expression of a disruption. And when there's a disruption, there's a solution to be brought, right? So when you are nimble and when you are agile enough and diversified enough, when you are in nat gas, you're in power, you're in technology, you're in oil, you have assets, you have shipping portfolio that you understand and you trade around, you can bring solution. So you can effectively help to reduce that volatility. And that's, we were talking about us entering into new markets like the metals. We see that added value. We're talking to miners that have, obviously, a producer problem in, making sure that they are performing and selling their production at the right price. But they have power issue, they have carbon issue, so if you can come to them with a package solution, which you have developed and that you're running with in your own strategy, that's making a huge difference.
So you're seeing this more as an opportunity rather than a risk?
I'm very optimistic, so by nature.
Short-lived is short-lived.
Short-lived, Jeff says.
It might be not long-term views, right? But short cycle, that certainly will bring opportunities.
Yeah. Well, that's all we have time for today. Please join me in a round of applause for our panelists. Thank you so much. And this brings to a close the FT Commodities Global Summit. Thank you all so much for being here. Thanks for your support, and thanks for some great conversations over the last 3 days. We hope to see you again here next year. Thank you.